Alright, I'm just gonna go over, like a basic trend review, but I thought that I might just do a little analysis as well. So, I'm gonna do some really basic analysis that really is the foundation um, of analysis, and that is to look at the simple bar or a candle. Now, this foundation really needs to be there in order to proceed because without this, there's no way you can actually read a chart and be very reliant on the indicators. So I'm gonna break this down in a way that makes a lot of sense. All right. So what are the four components of data that a bar or candle has? It has open, high, low, close. I'm not gonna go into the volume right now. All right, but just watch this analysis. Like it seems silly right now, but you're gonna see what how important it is and how powerful it is. So you have basically open, high, low, close. From this data, you get ratios. The one that most people know is high minus low, and that gives you the range. But there are at least three other ratios that are, one of which is extremely important. The other two are optional, but they are also like you don't need indicators. You just pick them up by looking at a chart. So this is the true range. The first one is the true range. The second is the open to the close. So it's basically the absolute value of the close minus the open. The absolute value of the close minus the open, which is gauging the distance between the open and the close. This is very, very important. It gauges the progress in the close, and I mean, it is absolutely critical, in my opinion. This is what most people they don't understand, and it's important not only on the bar, but when we compare it. So I'll go into all that in a minute. The third is the close within the range, meaning you have um, the high minus the close. If this is a small value, that means you have a high-end close. And for bearish bars, it would be the opposite. It's basically the close minus the low. Why is this important? Well, it gives you, in like old school technical analysis, what they do is they look at the bar. If it closes in the middle, that means supply and demand are matched. If it closes high end, demand is stronger than supply. That's old school. Like if demand is stronger than supply. If it's low end, supply is stronger than demand. See? Alright, so this is an old school way of comparing supply and demand relative to a bar is by taking a look at the position of the close within the range of the bar. Above halfway, demand stronger, below, supply stronger. So that's what this is about. And finally, the fourth ratio that we get is open minus the low, or the high for green bars, and high minus the open for red bars. Why is this important? It identifies the wicks and the tails, the wicks or the selling and buying tails. Now, most most folks will look at this at the top, the trading range, if they know about it, or they'll use the average with a 14 period average of 14 trading range. No, not trading, true range. The second one is critical. The third one, basically, if the second one has a high value, the third one usually has a very high value as well because they're highly correlated. And the fourth one, you can tell a lot. Like on the higher time frames, when they have those wicks, they set up areas where supply came in or demand came in. So based on these four components, open, high, low, close, of a candle or a bar, we generate these four ratios. All right, that's a lot of data. Okay, but the data by itself doesn't is not going to help. What you need to do is compare it. All right, so there's a very easy way of doing this. So you take one, for example, the range, and say the TR, and then you just compare it to the average true range, and see if it's greater or less than. And if you wanna get bigger numbers, you increase it by, let's say, 1.3 times ATR. This will identify a big ass bar, or not that big, but you know, uh, above average, and many signals will have this component. So now all you need to do is take any of these values. Let's call number 2. So this is number 1, right? Now you can take number 2, and all you do is take that value, CL minus open, which I'll just call it progress of the close, POC, not point of control, progress of the close, and then all you got to do is greater than 1 point, let's say 3 times POC. All right, and so you get the idea. You take the value of a single bar, the value of a single bar, whether it's the range or the position of close. And if you want to get if you want to compare it, all you do is take an average. You take the average of the last 14 bars at least. Actually, the least can be 10 bars, but anyway. So this right away will allow you to just compare the bar to the background. Get it? Comparing the bar to the background on the chart. Okay? And that sets up part of the context. There are other components of context. I'll be discuss that later, but that's the idea. So this is the basic foundational analysis of supply and demand based bars, where you're looking at the range and the close, and you may want to take a look at the wicks or the position in the close and just compare it to the background. And the way you do that, just get the average, like average range, like true range average for 14 bars, or the position of close for 14 bars, or the wicks for 14 bar average, or whatever. So this is the foundation, and this is totally different than looking for candle patterns, like all those candle patterns, because now we don't care about candle patterns. We're instead trying to gauge pressure, buying and selling pressure of a particular bar relative to the rest of the bars, to the immediate background, to the context, to prior periods. All right? So that's the point. That's all, folks.